Welcome to another YouTube video. So in today's video, we're actually going to look at the difference and the benefits and disadvantages of index funds, equity traded funds, and individual stocks. So when it comes on to different types of investing as investors, a lot of times we're so confused. We don't know where to really begin. Should we go all out in a particular stock? Should we track that index? Or should we just leave our money with an institution to actually figure it out? So all of that will be covered in today's video. So first, what we're going to look at is index funds. So index funds are really just created to actually mimic a particular index. So what that means is that the funds were created and it actually has the same amount of weighting that the particular index that it's tracking would also have. So for instance, in the United States, the two largest index funds are the Invesco QQQ, which tracks the Nasdaq index, and there's also the SPDR S&P 500 ETF, and that tracks the S&P 500 index. So you might be wondering, what do I mean when I say track the index? So really, the index funds were created to mimic the index that they're tracking. So if the fund is tracking the S&P 500 index, then what would happen is that the index fund that is actually tracking it would also mimic the behavior. So whichever way that the S&P might move for a particular day, a particular week, a particular month or year, that fund is also geared to tracking it that exact same way. So the index funds now, the weightings within the portfolio would change based on the weightings in that index. So if a particular company has the number one spot in terms of market capitalization within that index, and then let's say 3 years down the line another company takes over, then the index fund is also should be reflecting this type of change as well. So index funds are a great tool for someone who is just starting out in the stock market and they really are not sure what they want to invest in as yet. And so by just following the indexes, by understanding exactly what is happening within those indexes, you could invest directly into these index funds. Or if you're someone who's already investing in the market, so you're a seasoned investor and you're just looking for additional diversification which would not take up too much of your time, then index funds are a good diversification tool, as well as it really is mimicking the indexes. And so the funds that you'd put your money in would be a great diversification from your base portfolio. So the next one that we're actually going to move on to is ETFs. And earlier in the video I said equity traded funds, and some persons call it that. It's also known as exchange traded funds. And so what exchange traded funds really are, it's actually a fund that is created by a particular company, and it first has to be approved by the SEC. And once it has passed that approval stage, then it can be listed on the markets and ETFs really are designed to track whatever the creator wants it to track. So if let's say that you're interested in real estate, for example, or gold, but you're not sure what real estate stock to hold or what gold stock to purchase, a real estate ETF would be a great way to have exposure into that real estate market, or a gold ETF would be a great way to have exposure into gold companies. So ETFs can really track a particular industry, or it can just be pool investments placed together to really just perform the goals based on the company that created them. So other regions and jurisdictions would have ETFs that can also track different types of industries and in one. So an ETF really doesn't have to be tied down to a particular index or an industry. It can have a broad scale. And so with ETFs, if you purchase into one unit of that ETF, if that ETF has 100 companies, for example, then you would only own one stock, and that one stock would be the stock of the ETF. But that one stock would actually comprise of 100 different companies, all comprised into that one individual stock. So the benefits of ETFs is that if the companies they invest in pays dividends, then they usually would spread out the dividends back to the investors based on the proportion that you would have invested in the ETF with. So if you have, let's say, 5% of the ETF, then you get back, so if dividends are paid, you should get back about 5% of the dividends that were paid. So the good thing with the ETFs is that the dividends are shared amongst the investors, and you don't have to manage it because it is managed by a portfolio manager. The downside towards investing within ETFs, though, is that you don't have a say as to what companies are invested in. So if you would like a particular company to be invested in it, or they are invested in a particular company but you don't want to have any ties to that company at all, then you won't be able to make a decision to say sell that or buy into this. You would have to outright buy it for your individual portfolio. So that's some of the disadvantages with ETFs. And now we're going into stocks. Really is just a portion of a unit that you invest in within a company. So the more stocks you have is the more units within that company you would have. Now, some of the benefits with investing in a particular stock is that you have full control over what companies you invest in and how much your investments are allocated within these companies. You are able, if the company pays dividends, you get dividends. So the dividends are paid on actual individual stocks, so units held, and not your percentage within an ETF, for instance. So if you hold 100 units and the company, for example, pays 50 cents per unit, then you would actually be getting back 50 cents per unit of that 100 units, and that would be about $50 that you'd be getting back less taxes. So you get full control over what is going to be paid, what they say they will pay, and what actually is paid. And another advantage of having an individual stock is that you get to attend annual general meetings, AGMs, and you can vote and express your views. Now, if you're a very minor, small shareholder, so you're a minority, then they probably won't necessarily listen to your views, but you are allowed to express them. Those the company might not do anything because you, based on your holdings, it's really insignificant within the company, but the company does have to at least listen to you and hear you out, so you are able to express these views. Now, the negatives or downsides to owning individual stocks is that if the market changes direction from your trading strategy, then all losses would be borne by you. So you'd be the holder of all losses. And another disadvantage is that all decisions are made by you. So you don't have someone buying or selling into the company. So whereas if you had an ETF, the portfolio manager, depending on the type of ETF you have, may expect that the company, they could, based on their calculations and forecasting, could see that the company is actually going to be going through some tough times, and so they would make that strategic decision to lower their holdings within that company. As an individual stockholder, you would not necessarily have the expertise, or you might not have the expertise to actually lower, to forecast these predictions and know that now is the best time to exit rather than waiting a few more months. As an individual stockholder, you would have to solely rely on your research and your advisor, depending on the relationship and the policies of the company with the advisor that you would have chosen. So all in all, we looked at the three different types of stocks. So we looked at individual stocks, ETFs, and index funds. We looked at the benefits and disadvantages of each. With the individual stocks, you are responsible for all decisions that are made regarding the particular stock. You are able to, you get all dividends that are paid based on the amount of units that you'd have, and you also are able to vote and express your views at annual general meetings. With ETFs, it's managed by the portfolio manager, and so the decision makings, you would not be able to make those, as that would be solely done by the portfolio manager. However, you would be able to get dividends if the companies that are invested within the funds pay dividends, and the portfolio managers decide to share those dividends out, then you can get it. If they decide to reinvest it, that's also a possibility by the portfolio managers. And with index funds, the sole purpose of the index funds is really to track the index that they are, well, really tracking. So with the index funds, the weightings are solely set up, the weightings of the index fund, that is the composition of individual stocks, would be based on the actual index that it is tracking. So regardless, the companies that would have the largest holdings in that index would ideally get the largest weightings in that index fund, and the companies with the smallest holdings in that index would also get the smallest holdings within that index fund. So it's not a case where if you like a particular company over another one, that the index would have it much weighted much larger than the one that you would not have preferred. So if that's the case, then the best suggestion would be to invest in that individual stock, as the index fund's real goal and purpose is just tracking that index and nothing else. So depending on the movement of the index and the weightings and how the stock compositions are, that's really what the purpose of the portfolio managers to do, ensure that it remains in harmony with that index, and the returns, the gains and the losses are really mimicking exactly what that index would have been sharing as results for that day.